The plan for this webinar is to take you guys through some materials that the team here has put together, and then we will end on a bit of a discussion on the outlook for the year ahead. We'll invite Q&A around that time, but please do feel free to post questions in the chat as we go. I've got a team that will be looking at those and sorting them for the end of the session when we will turn to the Q&A on the floor. A quick intro to our firm, Baringa. We are a management consultancy and advisory firm with offices in New York, Charlotte, Houston, and Chicago. Offices in London, Brussels, Düsseldorf, Switzerland, and Sofia, and then in APAC, Singapore, and Sydney. We really differentiate ourselves by bringing genuine subject matter expertise to our clients to help them with tricky commercial decisions and investment decisions across the markets that we serve. We have a number of core verticals, energy obviously being one, but then financial services, healthcare, telecoms, consumer products are others, and we have horizontal capabilities too. So an example of that is climate being a cross-cutting capability that touches pretty much everything we do nowadays. So that's a bit on the firm Baringa. We, Tom, me, John, Kaylin, and Manon sit in the energy team. And then within energy, we are a full value chain consultancy. And what we mean by that is we have advisory capabilities across that value chain, from helping people to allocate capital into the energy sector, so investment decisions and M&A support, through to helping people set up trading capabilities, for example, in commodities markets, so power, gas, oil. We'll help people land a team, land a piece of a new piece of software, help produce the processes that underpin such organizations, and then through to kind of networks and retail, where we have offerings there too. Now, I mentioned the team. I'm Tom Harper, director here at Baringa, leading the Energy Market Advisory Office out of New York. I've been working at Baringa for 10 years in all things renewable, flexibility related, primarily focused on helping people understand the investment dynamics before they buy and sell assets and companies in the renewable energy space across initially Northwest Europe and now the US and parts of Canada. We have Manon on the phone in London, and Manon runs our auction advisory work across all renewables, with a particular focus on offshore wind. So she has a lot of experience in Europe and on both sides of the US, both coasts of the US, but also other geographies too, including France and Norway. And John here in the room with me in New York. He's a senior consultant focused on our Eastern Interconnect modelling, particularly PJM, MISO, SPP, a bit of vertical too. And he advises renewable developers on everything from project economics through to policy developments and incentives, including tax incentives. And then we have Kaylin over in London with Manon, and she's an economic consultant focused on simulating tenders and auction results in the renewable energy space. So she's been very busy in this space, as you can imagine. And she has a breadth of experience across US and UK on seabed leasing routes in particular. So without further ado, we will move on to the webinar itself. The content we have planned for you guys today is to give you a brief overview of the policy background, a snapshot of the industry today, how we see the development timeline looking, what the IRA has done for wind, offshore wind in the US, support schemes run by states, and then a bit on supply chain and developments in grid coordination. So John and I will lead you through that section. Then Kaylin and Manon are going to talk about results to date, so summary of seabed auctions that we've seen, particularly in the last 12 months, and an overview of recent OREC auction outcomes and what we might expect there in things like the New York station currently underway. And then we'll move into the outlook phase. We have a few tenders and solicitations coming up that we are watching and have a few thoughts on. There's new assessment criteria in these projects that we should also, our clients are also very, very close to and have been considering. And then we'll land on some key takeaways and take Q&A from the floor. So I will kick off with a bit of a snapshot under the policy overview section. So I think it's fair to say that 2022 began as a bit of a mixed year for the industry. There was uncertainty this time last year around Build Back Better and whether that would actually land and whether tax incentives, tax credits would be extended for all renewables, including offshore wind. But given the long lead time on offshore wind, the eligibility for the ITC was in question for a few projects. Anyway, by the summer, the surprise launch of the IRA meant that a lot of those questions that our clients were asking have been swept away, and the sector was being seen in a new light. I think it is fair to say that offshore wind is going to be a key pillar of decarbonisation in the US. I don't think that's under question anymore, given the level of activity that we've seen. The coastal population density suits offshore wind. Just fundamentally, there's a lot of great resource in the US, in the Midwest, in parts of the South, but actually accessing that with transmission build is problematic in many cases. And of course, the coastal population centres mean that offshore wind is well suited to serve those with relatively little onshore disruption. The industry is backed by huge targets. So we have the 30 by 30 Biden target, which is, we reckon, about $100 billion in today's capex. So a huge amount of money being directed by that target. And around 9 states have set targets for offshore wind with over 40 gigawatts of installed capacity. And you can see that on the bottom left of this page here. New Jersey leading the way there for near-term targets, but of course California is looking at 25 gigawatts by 2045. So pretty serious numbers. And then on the support side, the real show in town is the federal investment tax credits, up to 50% of capex there. Absolutely huge incentive. And the PTC, the production tax credit, is also applicable to offshore wind. And then on the state side, what we're generally seeing is 20-year offtake contracts, either ORECs or PPAs, and John will take you through the difference in those a bit later. And the idea is that these are normally set at above market prices to create subsidies. So the combination of a lower capex from the ITC and then the state subsidy provides the economics for the plant. This time last year, there were supply chain woes, and I think they're not going away internationally, but I think the US is a bit of a bright light in the supply chain space in terms of lots of companies rebasing here, setting up facilities here, given the IRA subsidy is also not just focused on projects, but the upstream supply chain as well. We have a little bit to share here, but I'm sure you guys are seeing the announcements from various OEMs on setting up on US shores. And then we're seeing a lot of deal activity. So of course, there's a huge private sector involvement in developing these sites around the US. They've been holding sites for many years now. There's a bit of jostling for position, a bit of rearranging of who's in what JV, and that's creating some exciting movement in and out of the sector too. And on those key players, we have a bit of a snapshot here. Now, I guess some of the interesting takeaways are that you have a mixture in the US of utilities, oil and gas companies, and financial sponsors. There's not many, if any, offshore wind specific developers. It's all quite large established companies. Now, joint ventures are very common across the US to ideally, basically diversify risk, but also to bring the different strengths of the different companies into projects. The initial pattern in the Northeast was of utilities partnering with household offshore wind names from Europe, like your Ørsteds, like your Avangrids, and we still see that today. Now, the interesting thing is that there's a bit of development there in terms of people like Eversource, PSE&G, looking at whether they can continue in this relationship. Tax equity capacity has been cited in the media as a possible driver, but we might see a bit more transaction activity there in coming months. There's been an uptick in projects with US-based companies such as Invenergy in Invenergy Offshore Wind at the New York Bight, and then again in California, which is really interesting to see, backed by asset management capital and local expertise. And we expect a bit more of that to be coming in in the pipeline. And then, of course, towards the southeast of the US, we're seeing some of the large investor-owned utilities get approval to chase down large projects such as Dominion, such as Duke, in their respective territories. And you can see a bit of a leaderboard there on the slide with Ørsted at the top, Avangrid and Equinor in second and third. This is largely based on the capacity that's been declared based on seabed leases today. But obviously, there is some work to do to figure out what capacity is going to be delivered at some of the more recently tendered sites, such as those in California. With that, I'll hand over to John, who's going to take us through the development process and what we've been seeing, both in terms of timelines, but also across the US. So over to you, John.
Yeah. Thanks, Tom. So you're going to take a look at really the development process timeline and also where things currently stand geographically. So we're going to start here in the graph in the top left with states and where they are in their development journey, where those pipelines are. So it came through on the previous slide, but is reiterated here is that the vast majority of the goings on in offshore wind right now are in the Northeast. So between New Jersey, New York, and Massachusetts. New York and Massachusetts, the only two states with projects currently under construction. They also have robust pipelines waiting for new OREC PPA tenders. So we're seeing things really seeing the industry start to mature in the Northeast. And if we look at the map to the right, you can see that indeed that is borne out again. But we see the geographic picture expanding. So the recent seabed auctions in the Carolinas, most recently in California, and you have different states in the Gulf, as well as out in Oregon, really starting to take a close look at what they can do with offshore wind and what are the potential benefits to state economies in terms of getting these operations set up. So with that, I'll take a quick look at really the timeline and the process, because it is a bit of a process and it does go on for quite some time. So it really starts in the planning and analysis phase, which is the earliest stage of the development pipeline. This is where you have states discussing policies, setting targets. So kind of at the beginning of that policy making. And you also have BOEM looking for getting stakeholder engagement on the specific wind energy areas and finalizing those wind energy areas that will ultimately go into the leasing rounds. The process takes generally 2 years before you move into the leasing process, where you move through the proposed sale notice, final sale notice, into the auction, and the ultimate lease awards. In years 3 and 4, this is when you have site control as a developer, and you're looking for offtake, which is obviously key to these projects. So you have states with their targets, with their policies that run competitive OREC and PPA solicitations, factoring in a wide variety of cost benefit analyses there in terms of what those projects will do for the state. Ultimately, projects get selected, you're running the financials and hashing out those contracts between the state and the developer. Now, it is interesting. Once you finalize those contract terms, there is still a lengthy period of time between kind of inking that contract and moving to FID and construction. And in the middle is this planning and permitting phase, which is a lot of review by BOEM, by state agencies, to really make sure everything is going smoothly. Everyone is on board. The environmental review has taken place, and you get final sign off. That process can take another, 3 years or so until you ultimately FID the project and get notice to proceed and start construction. So that is, in that regard, it does make for some challenges. in that time delay, because you can have things throw a wrench in the process, like we've seen recently with the macroeconomic environment changing significantly. Additionally, signing a contract before knowing the cost to interconnect can also be a challenge, though some states are thinking that through as well. So all in all, looking at about a 10 plus year process, and we're starting to see more and more states get into this early planning analysis phase.
I think the interesting thing was last year is when we actually had that planning process, I guess, complete for Vineyard and a couple of the early movers, so people see what that process looked like, where there could be delays, and the hope is that that there's learnings from that, and they can squeeze that down a little bit further than they have done in the first of kind projects. Great.
And so I think it's been touched on. It'd be remiss not to mention the Inflation Reduction Act and how that's changed the picture over the past year in the outlook for the industry as a whole. So with I guess taking a look prior to the Inflation Reduction Act, where you would have had the expiration of the ITC, you can see what that means for LCOEs, and also what that means for kind of the missing money that state policy would have to pick up. So in these graphics along the bottom, we're looking at a representative offshore wind project coming online in 2028 with a capital recovery period of 30 years and a WACC of just north of 8%. So with a 0% ITC, you have a $90 LCOE, no benefit from the ITC, and you have, our modeling shows about a $28 capture price for these wind farms, and a $4 benefit from capacity markets as well. And so that leaves a $58 tab essentially to pick up on the LCOEs by the states. With a 30% ITC, we start to see the picture move around. So the federal incentive picks up about $21 of that LCOE, leaving states to pick up the remaining $37. And as Tom mentioned, there are adders available specifically for using domestic content, which can get the ITC up to 40%, in which case you have a pretty good split in terms of the support for these offshore wind projects between that federal investment tax credit and the missing money that state governments and state ratepayers ultimately pick up through the likes of ORECs and PPAs. So really it has been a revival, the Inflation Reduction Act, to say the least, in clean energy technologies across the board, but in offshore wind as well. I mean, this time last year, having conversations with folks worried about meeting the safe harbor requirements by the IRS to qualify for the ITC, a bit of nerves there. And now we have 10 plus years of firm policy support with the ITC to provide that medium to long term certainty.
Absolute game changer. Thanks, John. Down to that state's half of support, I guess.
Yeah, so we talked about that missing money, and it comes to the question is, how do states ultimately provide their support? And it is through what you call offshore wind renewable energy certificates, or PPAs, for these offshore wind developments. So the exact mechanics vary state by state in terms of how the money moves around, but in the end, it is a fairly similar structure to, I think, what you call a contract for difference over in Europe, where projects get a fixed payment for each megawatt hour that they generate. There are, however, some, call them idiosyncrasies or slight differences between different states' approaches and how they oversee these mechanisms. So an interesting one is actually New York, where basically the value of the subsidy is indexed to a zonal energy price. So that leaves the project with a basis risk between the node that they tie in that they tie into the grid and the ultimate zonal energy price that their contract, call it contract for difference or OREC, however you want, is indexed to. I think the idea there is to incentivize projects to pick the optimal tie-in location. How many optimal or suitable locations there are to tie in is a bit of an open question, but that is the idea there. Another one is New Jersey and Maryland. The ORECs are actually governed by regulatory order rather than contracts. So it is something to be aware of, that there is some regulatory risk if there are some future changes in terms of their view on offshore wind and the ORECs. And indeed, with that map of projects, or excuse me, states beginning to go down the path of ironing out their policies, we have not seen what these policies will look like exactly from Oregon, Delaware, Carolinas, or the Gulf states, waiting to see how that develops. And I'll also say, just on the transmission point, states do have different ways of including those into the PPAs or ORECs in their bidding processes. It is typically the case that the developer is on the hook for those interconnection costs, and they need to bake that into how they bid into the state solicitation, the competitive PPA or OREC process.
And it's just a good point to bring up the inflation point, just, different treatment of inflation.
Yeah, that is also a good point in terms of some states, it's basically a fixed price contract for difference. So you get that fixed price and it remains constant in nominal terms throughout the typically 20-year duration of the OREC or PPA. Whereas in others, you can index that payment to CPI, and so which would act as a bit of a hedge to inflation as it changes over the project lifetime.
Well, I think given the timelines that you were discussing earlier and the difference in the treatment of indexation and inflation, that's probably putting various parties under strain, given they're having to wait so long between contracting and final investment decisions. So it's an interesting approach different states have taken, for sure.
And so on the point about transmission, I think we're starting to see, and we have seen, states look at how they can best get out in front of the issue that is transmission and tying in different offshore wind projects to the land, to land. So it's one where there are cost savings to be realized if you do coordinate this effort, but hashing out what those policies and the who pays is always difficult. We have seen New Jersey go through and a bit of a first of a kind effort and be the first state to really take this head on. And so they are looking, and have worked with the regional transmission operator, PJM, to facilitate a coordinated approach to getting out in front and reinforcing the land-based grid, and actually the best way to tie in the offshore wind farms as well. Just so the idea being that you can accommodate additional build by kind of beefing up the network on the grid prior to those projects actually being built. So a bit of a socialization in terms of the cost of these upgrades. So what this looks like for New Jersey and PJM is, New Jersey says to PJM, we want to fund the transmission upgrades across our ratepayers in New Jersey, but we want to use you to tell us what projects should we be funding. So PJM got back to New Jersey and put out potential combinations of onshore, offshore projects, transmission projects, and then went out and tendered basically an RFP process to transmission developers to see what those ultimate implementations would look like. So there were 13 applicants, 80 proposals received, and the selected bidders, the winners, were announced just a few months ago in October. So we had the bulk of the work coming from JCPL, the local utility, as well as Mid-Atlantic Offshore Development, which is a joint venture between Shell and EDF. So this breaks down to $1 billion of investment from the New Jersey ratepayers into getting ahead of this problem and kind of putting them on their path to reach actually the increased target of 11 gigawatts of offshore wind.
Yeah, I think we're seeing in various conferences and in the media that other regions are likely to follow. So New England, obviously more difficult because it's multiple states, but looking at something similar, like coordinating development across the Long Island Sound, so they don't have too much disruption crossing the coastline there. And then California, very well known for having quite a weak land-based grid. And so there's actually the potential there to use a coordinated offshore network to help mitigate existing constraints, i.e. what we would otherwise call loop flows, or a bit like a wheeling out into the sea and back again. So that's something to watch, and obviously provides another route for developers to exercise their skills in transmission development and coordination with both generation projects and the incumbent utilities.
Then the last thing to touch on is supply chain. So the U.S. is well on its way in terms of developing a project pipeline to meet that 30 gigawatt goal by 2030. But supply chain is an impediment to reaching that goal. We need to beef out the supply chain in order to accommodate and ultimately build the pipeline we currently have. So we have a number of policies and sort of things kind of greasing the wheels to get the pipeline, to support the pipeline build out. You have the investment tax credit, 30%, or with the potential for a 10 percentage point adder for that domestic content, providing a kind of a subsidy for the build out for these developers. Then you have the state level procurement targets and policy support through the ORECs and the PPAs that we've talked about. Currently, 40 plus gigawatts of offshore wind targets. And we also have BOEM providing a clear runway of lease areas. So basically, they're queuing up their pipeline of lease areas so that there is a bit of certainty that the project pipeline will continue to develop just as they've formalized that process. So we have the upcoming lease auctions in the works for the Gulf, for Central Atlantic, Oregon, as well as the Gulf of Maine. So with that big pipeline, you have the supply chain challenges, which I touched on. So just running through some of these, it stems from the fact that we're at a bit of a standing start. So we don't have a lot of existing infrastructure and manufacturing capability to handle turning the pipeline of projects into actual wind farms operating off the coasts. So to give a sense of this, the U.S. has only one wind turbine installation vessel currently in the works. All indications point to needing significantly more, closer to 4 or 5 of those vessels. And so we're starting, but there is a pain point there. We could lean on the European manufacturing base, but Europe has its own robust offshore wind pipeline that these U.S. projects will be competing with. And so it's not sure not too much flex in terms of looking to Europe for support to at least reach that, once you get into 20 plus gigawatts of development, there needs to be some reshoring and domestic build out of the manufacturing capability. And while you have the IRA providing a pretty good runway, 10 plus years of tax credits, when you think about setting up a manufacturing process that takes 3+ years to set up. You want to make sure that the pipeline continues to be built out. So if that process takes 3+ years to set up, now you're looking at a 6-7 year runway, and you want to make sure you have an order book that will be able to justify the CapEx. And then one final thing to bring up is the need for a specialized workforce. And in conversations with folks developing these projects and right around these developments, see that there needs to be workforce mobilization. So one thing that keeps coming up is a shortage of marine grade welding capability. Obviously, there's going to be some in the Gulf of Mexico, that is, with the oil and gas offshore developments there, but that is additionally a constraint. And with that said, there are a number of challenges, but there are a number of efforts to help overcome these. So before the IRA, you had early efforts from developers to vertically integrate. You had the likes of US Wind vertically integrating and investing in Sparrows Point steel for monopile manufacturing. You had Dominion getting out in front and constructing the first US wind turbine installation vessel, Charybdis, down in Texas. And now you have the Inflation Reduction Act providing tax credits for domestic manufacturing. So these are for the installation vessels for nacelles, blades, kind of a laundry list of you name it, and there is a credit available for it. And you do have the supply and demand side push from the Inflation Reduction Act as well. So you have the domestic content adders and you have the manufacturing tax credits. So developers are incentivized to use domestic content and manufacturers are incentivized to set up those capabilities. And lastly, a recent development just in the past year is the BOEM multi-factor auction formats, where BOEM will give additional credit to the auction bids if the bidders go out and say, yes, we will put capital towards supporting the development of the offshore wind supply chain or workforce. So just an injection of capital from those entities into the supply chain and workforce development. So we've seen that in the Carolinas auction as well as the California auction. So while we have a challenge here, we have a pipeline, we have supply chain constraints, we do have efforts that are ongoing to really try and tackle these and get us on track to exceeding that 30 gigawatt by 2030 goal.
Great, thanks, John.
So now we'll look at how these policy kind of evolutions have translated into some of the results of the tenders that we've seen in the last year. And then we'll take this a little bit more on a forward-looking basis. So in terms of those competitive tenders, I think what's worth to say as a scene setter is that there's many drivers that kind of drive the valuation of the sites and the results of those tenders. Some of those drivers are site-specific, some of them relate to the local context as well, and some of them just relate to the design itself of the process. So in terms of the site conditions, obviously favorable site conditions will attract more favorable bids. So that would relate to high wind speeds, relatively shallow water, also proximity to shore being some of those drivers that are quite favorable. And then the second aspect is around the policy environment. And I think as we've spoken to earlier in the session, the policy environment is very key in order to attract interest from the bidders. And as part of this, in particular, the definition of a clear offtake policy for the project is very important, where we've seen tenders which had that clear policy kind of, a bit better attended and also higher valuations or better valued than tenders where there was lack of clarity in that space. There's also economic risks and kind of the context of the wider environment. At the moment, I think everyone is aware that there's significant inflationary pressures around the cost basis of developers. And I think this is also being coupled with increased cost of financing, which also places kind of upward pressure at the offtake stage, downward pressure at the seabed valuation stage. John has touched on the importance of the supply chain and the existence of, local infrastructure that can be drawn upon. Obviously, as being a facilitator, something that also de-risks the process to some extent. And I think especially as there's increased requirements around development of that local supply chain. Something that is also being talked about quite a lot is around the grid. On the offshore side, I think just a good kind of proximity to show, reducing the costs for developers, increasingly talking about coordination as well, and kind of the clarity around any regimes for coordination. And finally, the onshore availability of grid infrastructure, where historically, some sites were allocated even internationally without much concern to actually the ability of the onshore grid to accommodate those projects. And this also needs to be considered very carefully, especially as we have a lot of offshore wind capacity now coming online. And finally, as I've discussed, the auction design is also quite a big driver in terms of the results that we see with, price-based allocations, in obviously targeting the focus of competitors on price solely, and so getting quite competitive bids in relation to this, but increasingly, the move towards multi-factor tenders, widening the scope of competition across multiple criteria. And the competition in the tender finally with, different levels of competition driving different levels of competitiveness of the bids. And competition is very much the result of the various factors that we have discussed, where if there are favorable conditions, then generally there will be a lot of interest in the tender. So again, in terms of the wider scene setting, if we can move to the next slides, I think it's also worth just bringing the US standard design and sector in context with some of the international regimes. I think it's fair to say that in the US, the regime is relatively decentralized, as we would call it, with various stages of development, starting with seabed, then obviously a separate process for the offtake, also the interconnection being largely the responsibility of developers. In terms of the tender design, initially largely focused on price, but now moving towards more hybrid criteria. And I think that this is a very similar school of thought with what we're seeing in the UK and GB in particular, where similar evolutions are also happening with, initially a price-focused process, and now increasingly moving towards other criteria. Also increasing the level of coordination on the grid aspect, so very similar evolutions in those markets. And I think, because the competition has been historically focused on price, this has attracted some very competitive pricing points that we'll discuss in a minute. And this contrasts slightly to some of the Central European model, where it is more centrally planned, where essentially you have only one process which allocates both the seabed and the offtake, and the connection is being planned centrally by the TSO. And that kind of other way of developing offshore wind is a little bit less risky from the developer's perspective, and that has managed to attract some subsidy-free offshore wind recently, in particular in the Netherlands. So now with this scene setting in mind, we'll turn to some of the results that we have seen in 2022.
So 2022, I think, for the US was a really important year towards establishing the pace of offshore wind development, and also, making the US an emerging leader in offshore wind development just by the sheer capacity that we have tendered this past year. And so this last year, we had almost 13 gigawatts of offshore wind capacity tendered across 3 different allocation rounds. And these tenders were really important towards, making sure the US was able to meet its overarching 30 gigawatts of offshore wind capacity operational by 2030, as well as their floating wind target they have set recently. To give a bit of color, the New York Bight auction, if you go to the next slide, was held in February. Here we had 6 sites that were tendered for a total capacity between 5 to 7 gigawatts. And these sites were held off the coast of New York and New Jersey. So in terms of kind of market context, offshore wind market context, as John mentioned, you have pre-existing sites that are being built there throughout different phases of planning development. So some of these sites have gone through the OREC and PPA processes, and most of the supply chain and infrastructure requirements for building the offshore wind in that region has, largely been starting to establish and will continue to grow. I think this tender brought in a lot of hype from international competitors, as this was the first offshore wind tender to happen since 2018. And this was, the largest capacity ever to be tendered in a U.S. auction. So with that brought it, really high valuations in the sites and really high competition during the auction. So the tender itself brought $4.4 billion US in total proceeds. To put a bit of color to that number, that is about 3 times the amount of revenue that was earned over the past 5 years for the oil and gas sites. So a huge signifier that there's a lot of value in the central Atlantic coast, and that people are wanting to invest in the region. Next, the Carolina Long Bay. This was held in May. It had much smaller capacity that was being tendered across 2 sites. I think in terms of the market context, there isn't much being built in terms of offshore wind. That's mainly held in the New York and New Jersey region. And so with that brought a lot of, developer insecurity, I'd say, in terms of, investing into those sites. Most importantly, as Mano mentioned, is that the lack of clear offtake mechanism for the region. And, with that, coupled with, lower retail prices in the Carolinas, in contrast to PJM, may have garnered a bit of developer risk associated with the development of the sites that did not exist in New York. And so, what this led to was, a lower valuation for the sites themselves, and a lower competition as well. Lastly, a unique point that John mentioned as well, sorry to go back a moment, we had that BOEM credit also being added. So, a shift away from quantitative to more qualitative mixed criteria, if you will, for the seabed lease standards. And then lastly, California. This is a really exciting tender that happened in December. This was the first floating wind auction to take place in the US, and the first tender off the West Coast. So really important towards, establishing, sentiment behind the developer interest in, developing offshore wind on the West Coast, as it is a nascent industry. And, towards establishing a benchmark for the floating wind projects, if you will, in the coming tenders in the next year. So 5 sites released here. 2 of them were located in Northern California in the Humboldt Bay region, and 3 in Southern California, with a really decent $757 million for the sites. So considering this is a floating wind project and the first West Coast auction, really high valuations for the sites. So that gives a brief overview of the auctions and some of the outcomes. I think in terms of the auction pricing and level of competition that we've seen, I think the spread in the valuations, again, come from those key drivers that Manon discussed. And so we have, a clear difference in the dollar per megawatt valuation between those 3 tenders. Key points here being the fact that some markets had, clear offtake mechanisms in place, specifically New York Bight, whereas others did not. As well as, the technical site characteristics as well. Carolina and New York Bight dealt with fixed bottom assets, which have been developed in the US and UK for quite some time. Whereas, California was dealing with a floating wind technology, which is quite risky, and, is on the beginning phase of development globally, if you will. California also had, unique challenges. The fact that you're starting to build offshore wind development in the region from scratch, and you're also dealing with very deep waters. And so, currently there are no existing operational floating wind farms which have operated in such deep waters as in California. So, you're really dealing with a lot of developer risk for the technology itself. At this time, you're also having, these great inflationary pressures that developers are starting to deal with and really coming to light during this time, which also may have muted the valuations from the sites. Another interesting benchmark just to pull out from this slide is comparing the US versus the UK auction outcomes, because the UK has had some recent seabed tenders for both fixed and floating, and so that can provide really interesting color to the US results that we see. So the first one I'll compare the UK to the US tender rounds to is the leasing round 4 in the UK. So this leased 6 sites, 6 fixed bottom sites in 2021. In terms of US outcomes, we see the New York bites have similar valuations to the leasing round 4 sites, as well as similar levels of competition. Again, I think key drivers of this being the fact that you're considering a market or region where you have similar characteristics such as a clear offtake mechanism. So for context, the UK has the CFD subsidy, which runs every year to support offshore wind development, as well as a really strong offshore wind pipeline in the UK, considering it has such great wind resource availability. And so you see, similar valuations to New York Bight, which also has an OREC mechanism, as well as existing offshore wind farms nearby. California, I think, is a useful benchmark to compare against ScotWind. And so this happened last year where about 20 gigawatts of fixed and floating technologies were tendered. I'd say California sites are higher than what we saw in ScotWind, but I think that is largely an artifact of the underlying auction design mechanism that was used between those 2 auctions. So for context, ScotWind had a price cap during the auction, which prevented developers to really reflect the valuations of the sites in their bidding behavior, whereas the mechanism for California, which has been held largely consistent throughout the year, allows developers to really price in their valuations for their sites, and allow them to engage in pricing discovery a bit better than an effective price cap, which we saw in ScotWind. And so, I think this is good news in saying that, the California sites, despite having, a lot of challenges associated with it, have a lot of, interest from international parties. So that's the seabed lease view. In terms of, what we saw for OREC and PPA pricing, there is currently a New York OREC tender process underway, which I think we'll know the outcomes in the next few weeks or few months. But I think what we can say overall is that we see a strong decline in the costs for developing offshore wind over the past 5-10 years. And I think that matches what we've seen in terms of the OREC and PPA pricing contracted terms that we have currently seen. And this is on par with kind of some global benchmarks seen in the UK, specifically the leasing of the CFD round that happened this past year in 2022. And so those are those pink bars that we have in that chart. And so we see kind of on par reduction in costs in the US, similar to what we've seen globally. I'd caveat by saying, I think in the next few years, as we mentioned, there are inflationary pressures and supply chain requirements that are now being embedded in the BOEM leasing tenders, as well as the OREC tenders themselves, which will likely, result in a bounce back or even a flattening of this, decrease in costs. With those inflationary pressures, I think we've also seen that developers quite concerned over the financial viability of these sites, both within the US, so Commonwealth Wind and Mayflower, as well as some of the sites that were awarded a safety contract in the UK. So we see, quite a bit of discussion that will likely happen over the next year over, how that indexation and the inflation treatment will be considered in these contracted terms over the next few years. Last thing to call out here is that, for the most part, we've dealt with fixed technologies, which, have been established for quite some time globally. Now we're going to start seeing more floating wind technologies entering our pipeline mix, which will likely, increase the costs of, the development of offshore wind over the next few years, as well as, greater technological challenges for developing those assets. So that may also, reduce some of the, cost reductions that we've seen over the past 2 years.
Great. Thanks so much, Caleb. We'll now move to the outlook part of the webinar for the last 10 minutes. If you fancy posting us a question and you haven't already, please do. While we start looking through those questions, we're just gonna tee up the discussion with what we're looking at for this year in terms of known processes. Caleb, maybe if you give us a quick whistle-stop tour of what we are expecting to be tendered and what the fundamentals are there, and then we'll open to the floor. I think, yeah.
Yeah, I can do that quite quickly. So in this next year, I think BOEM is planning on holding 4 tenders. The first one being in the Gulf of Mexico. This has expected to come in the next few months, and we're dealing with fixed bottom technologies. So similar to what we had in New York Bight and the Carolinas. In terms of unique characteristics of the market, I think as Tom and John mentioned, the region has experience with oil and gas, and so have an existing workforce as well as local and regional supply chains which are well equipped to develop the offshore wind farms there. Central Atlantic is next, and this will happen in mid-2023. Total capacity is yet to be confirmed, but quite a sizable chunk. I think it's similar to New York Bight. What you have is existing wind farms nearby, known offtake mechanisms, and many alternatives to connect into the grid. So this likely attract a lot of competition and valuation for the sites. Next one is the Oregon site. So these are, floating wind technologies in really deep water, similar to what happened in California with an emerging market. And then lastly, the Gulf of Maine, which is really in early stages of development at this point, but a lot of acreage under consideration and really, good wind resource for the region. So exciting space to watch next year.
Thanks. I guess we flag the Central Atlantic region as green in a lot of the political support there, but there's obviously a few states in that region that have policies or don't have policies. Yeah, I don't know, John, if you could give a bit of a flavour of what we mean there.
Yeah, so it is, I guess, at least in terms of offtake and basically political support with Delaware, Maryland, Virginia, I think very, very strong political support. I think it remains to be seen what the offtake will look like in the Carolinas. So not to say it won't be favorable for developers, but a bit of a wait and see there. And I think offtake is a very important point here because that is really how these developments, that is their route to market. And so down in the Gulf, it remains to be seen as well what that offtake mechanism will look like and the amount of support it would provide for projects. You have the governor in the state of Louisiana looking to get basically a piece of the pie, get some economic development from offshore wind, but it's a bit of a question as to who's going to foot the bill because it is significantly more expensive than the onshore renewables build out.
Thanks, John. Got a couple of questions from the floor. The Catch Mystery says, thanks. Any reflections on the recently announced EU Green Deal industrial plan and how that will effectively impact the spending of European companies like the Ørsteds of this world, European oil and gas in future US wind projects? I mean, over here, it hasn't really affected what we're hearing. Now, these things do take time to bed in, but we're seeing announcements, quite coming each week, basically, on people either European companies investing in, not European, just European and other companies investing in the US, and people snapping up their order books. And I think given the domestic content requirement, there's no reason that the EU Green Deal would change that anytime soon. But maybe over to Manon and Kaylin on your perspectives over in London.
Yeah, I think what you're saying is relatively fair. I think we're seeing a continued very strong interest in investment, and I think we're expecting this to continue going forward, really. And I think that also is combined with, the Ukraine crisis in Europe, which has really increased the need for kind of having local secure energy and move away from some of the gas. So I think a lot of countries have increased already their ambitions, and in association with that, I think the industry is definitely gearing up for trying to meet some of those requirements. In terms of, I've seen a question in the chat on floating offshore wind. And this is a technology that we've looked at in the US, obviously, and here in the UK. I think it's fair to say that we consider that this technology will probably continue, at being at a premium against fixed bottom for at least the next decade. I think it's fair to say. In the UK, this year was a CFD round, which for the first time allocated a floating offshore wind project alongside some fixed bottom. And the price that came out was about twice as high in terms of the offtake price, which is very significant. And that was meant to be one of the more kind of competitive projects which benefited from site-specific synergies. We do expect that this kind of premium will come down over time as the supply chain gets set up, as the technology becomes more mature. I think also having been to a floating offshore wind conference in the last couple of months, there was a wide consensus in the industry that maybe the cost reductions that we've seen for fixed bottom will not be quite as drastic and fast for floating. And that's because there's increased requirements around some of the local supply chain, and that takes time, but that also limits the ability to kind of import for the cheaper technology. So I think, we were also going to touch on some of the wider evaluation criteria. And I think it's a very fine line for governments where they try to, on the one hand, get the best price for consumers, but now they're also trying to ensure that there's jobs being created in the economy and that the countries benefit from some of that development. So essentially, you may trade off some of the cost reductions in OREC and PPA prices for some of the wider economic benefits locally.
Yeah, thanks, Manon. Another one from Diane Charlotte Simon on, can we share any insights about PPA pricing in the context of cost increases related to inflation and some example of PPA renegotiation? Now, in the US, as far as I'm aware, there hasn't been any renegotiation yet, but all eyes are on the Avangrid situation in Massachusetts at the moment, with Commonwealth Wind in particular, and what the end result of that will be, because it feels like a bit of a back and forth stalemate situation at the moment, and obviously feels like things can't get done in given the cost environment and given the PPA price for Avangrid. So that's one to watch.
And I think that we're seeing a very similar pattern on the other side of the Atlantic as well, where some of the recently allocated wind farms, almost like 7 or 8 months ago, are finding it quite tricky and are really feeling the pressure. So I think that kind of speaks to some of that wider reversal of costs across a range of, reasons, really, from the supply chain perspective and, some of the capex increasing, the cost of financing increasing. So I think that there's several elements that are putting upward pressure on prices across the globe, really.
We've got a couple of other questions relating to supply chain, which we might just answer you over email after the session because we're aware of time. I think we'll just close on some final thoughts. Thanks for everyone for submitting their questions. In our view, the US market is a hot market, and we think it's going to become one of the top 3 globally by installed capacity by the end of the decade. So that's broadly China, UK and US. And there's obviously going to be lots of deal activity as projects pass from seabed to OREC and so on. The IRA is a super stimulus, but the state, don't be carried away by it. It does a lot of the heavy lifting, but the state government support is absolutely crucial and will be going forward for things like that question on floating offshore wind. Basically, it's a question of how much is California willing to pay, really, and that's something that will come out in due course. Careful design of state support contracts is crucial. We've seen the unwinding of the economics for a few wind farms we just touched on then. Inflation and proper indexation of contracts, expecting the long lead times that John was suggesting earlier should really be baked in. Increasingly, high seabed prices are being scrutinised by all sides. We do see this coming up again and again, and we're kind of thinking that the New York bight is probably the ceiling on where prices will go in the future, given inflation, given the knock-on impacts that creates for the project costs and the ultimate state PPA that has to be drawn off the back of it. And lastly, qualitative criteria can win or lose a contract. Now, we'll circulate the slides to all you guys on the phone. There's a nice page that Manon and Karen have put together on the importance of qualitative criteria in these assessments, which our clients are looking at very seriously. So with that, we thank you for joining. It's been great to run through materials with you guys, and we will send the slides as a follow-up. So thank you very much and enjoy the rest of your days.
Thank you all.
Thank you.
Thanks.